There is a window of roughly 9 days between the moment extra money arrives in a British current account and the moment its entire future has already been decided. Not decided consciously. Nobody sits down with a spreadsheet and rules that the overtime payment shall be converted into a slightly better weekly food shop, 3 deliveries, and a subscription they will forget to cancel. It just happens, quietly, through a series of individually reasonable choices that only look like a pattern when you zoom out far enough to see the balance drift back to where it started. That drift is the single most reliable finding in the entire field of personal finance behavior. Income goes up, wealth doesn't. And it doesn't fail to go up because people are stupid or lazy or bad with money. It fails because money that arrives without a pre-assigned destination gets assigned one by default. And the default destination is ambient spending. So this video isn't a list of tricks. It's an attempt to describe what people who consistently convert extra income into actual net worth do differently, based on what the research and the data actually show, rather than what sounds inspiring. And a warning up front, none of this will make you rich. That's not what these habits do. What they do is shift a probability distribution. They narrow the range of bad outcomes and modestly widen the range of good ones. That's a less exciting claim than most financial content makes, and it's the only one the evidence supports. Let's start with the window. Richard Thaler won a Nobel Prize partly for describing something called mental accounting, the observation that humans don't treat money as fungible. A pound is a pound mathematically, but psychologically we file money into separate mental folders based on where it came from, and we spend those folders very differently. Money labeled salary gets treated with a certain seriousness. It pays the fixed costs. It's associated with effort, with the month, with obligation. Money labeled extra, a bonus, some overtime, a freelance invoice, a refund, back pay after a delayed pay review, lands in a completely different folder. And the research on windfalls is consistent. Money that feels unearned or unexpected gets spent faster, more impulsively, and on categories the person wouldn't normally consider. The practical consequence is that the fight over your extra income is not a fight about willpower at the point of spending, it's a fight about labeling at the point of arrival. Once the money's sitting in the same account as your groceries and your Friday night, it has already been relabeled as ordinary money, and ordinary money gets spent ordinarily, which is why the first observable habit is so boring that most people skip past it. Allocation happens before arrival, not after. People who reliably keep extra income decide where it's going while it's still theoretical, before the bonus is announced, before the invoice is paid, before the pay review lands. They set up a standing order or a transfer rule that moves a fixed percentage out of the current account within 24 hours into an account with a name on it. Not savings, a name. Van replacement, 6 months of rent, course fees. This sounds like decoration. It isn't. Thaler and Shlomo Ben-Artzi built an entire retirement savings program, Save More Tomorrow, around the finding that people will happily commit future money to a purpose when they'd never commit present money to the same purpose. Pre-commitment works because it moves the decision to a moment when the money is abstract, and abstract money is much easier to be sensible about. The people who do this well are not more disciplined than you. They've just arranged things so that discipline is required less often. Here's where a lot of otherwise sensible people go wrong. They have one strategy for extra money, when extra money comes in at least 3 distinct varieties, with completely different risk profiles. The first is repeatable income, a pay rise, a promotion, a retainer client that pays the same amount every month. This income has low variance and high persistence. You can reasonably expect it next month. The second is semi-repeatable income, overtime, commission, shift premiums, a seasonal bonus. It arrives regularly enough to feel dependable, but the amount swings, and the whole category can vanish if your employer's order book changes or your sector has a bad year. The third is one-off income, back pay, selling something, a settlement, a gift. It happens once and there is no expectation of a repeat. The reason this taxonomy matters is that only one of these 3 should ever be allowed to raise your fixed monthly obligations, and that's the first one. When people convert semi-repeatable or one-off income into a recurring obligation, they've taken volatile money and used it to buy something that isn't volatile at all. The subscription doesn't care that overtime got cut. The finance agreement doesn't renegotiate itself because commission was soft this quarter. Economists call this a ratchet. Fixed costs go up easily and come down painfully. Adding £180 a month of commitments takes one afternoon and a couple of forms. Removing £180 a month of commitments takes cancellation fees, early termination charges, awkward conversations, and in some cases a period of visibly downgrading your life in front of people who noticed the upgrade. So the habit is this: repeatable income can adjust the baseline. Semi-repeatable income funds reserves and one-off purchases. One-off income never touches the baseline at all. It goes to structural things, clearing a balance, funding a buffer, buying an asset outright. The corollary is one of the more useful heuristics floating around. If you get an increase in variable income, wait a full cycle before doing anything permanent with it. 3 months of consistent overtime is data. 1 month is noise. People who treat noise as data end up with a cost base built on an assumption that stopped being true in February. Once money has been labelled and classified, there's the question of where it actually goes, and there's a reasonably strong consensus on sequencing, which follows one principle: deal with the certain things before the uncertain ones. Certainty layer 1 is the buffer, not because cash is a good investment, it isn't, and over long periods it reliably loses purchasing power. The buffer exists because the cost of not having one is enormous and non-linear. Without cash, an unexpected expense becomes a debt at 25% or 40% interest, and that debt then eats future income for months. The FCA's research on financial resilience has repeatedly found that a substantial minority of UK adults, somewhere around a quarter depending on the survey year and definition, would struggle to absorb even a modest unexpected cost. The buffer isn't about returns, it's about preventing a small problem from converting itself into a compounding one. The usual guidance is 3 to 6 months of essential outgoings, but the more useful version scales to your income volatility. If you're salaried in a stable sector, the lower end is defensible. If you're on variable hours, commission-heavy, or self-employed, you need considerably more, because your income shocks and your expense shocks can arrive in the same month. Certainty layer 2 is matched money. If your employer offers to match additional pension contributions beyond the auto-enrollment minimum, and many do in bands, often to a few percent, that match is an immediate return that no investment strategy on earth can reliably beat. A 100% match is a 100% return on that pound, before the pound has done anything at all. It's one of the very few places in personal finance where the outcome isn't a probability distribution, it's just arithmetic, and a striking number of people leave it on the table because they never read the section of their contract that explains it. Certainty layer 3 is expensive debt. Paying down a balance charging 24% is mathematically identical to earning a guaranteed 24% return, and there is no publicly available investment offering that with any reliability. Overdrafts are worse, since the FCA's pricing reforms, arranged overdraft rates in the region of 35 to 40% EAR have become fairly standard across the major banks. The order here should be interest rate first, not balance size, whatever the psychological appeal of clearing small balances quickly. Only after those 3 layers does discretionary investing make sense, and the reason is simple. The first 3 have known outcomes. Investing does not. You put certainty first because certainty is where the guaranteed returns live, and there aren't many of them. A lot of content about extra income skips straight to what you should do with it to multiply it. Start a business, trade, buy into something. And this is where the analytical framing matters most, because these options are usually presented with their best outcomes and almost never with their median ones. The distinction between mean and median is doing enormous work here. If 10 people try something and 9 lose their money while 1 makes a fortune, the average outcome can look excellent, while the typical outcome is a total loss. Averages are dominated by outliers. Medians tell you what happens to the person in the middle, which is to say, most likely you. ONS business demography data has consistently shown that only around 4 in 10 UK businesses are still trading 5 years after they start. That's not a condemnation of entrepreneurship. Plenty of those closures are voluntary, and the people involved often come out with skills and contacts worth more than the money. But it does mean that put your bonus into starting a business is a decision with a wide outcome range and a median that isn't obviously positive in cash terms. Retail trading data across multiple regulators tells a bleaker story still, with the majority of retail accounts in leveraged products losing money, a figure firms are legally required to display precisely because it's so consistently high.
Compare that with the shape of the boring options. Clearing at 24% balance has a variance of essentially 0. An employer match has a variance of 0. A diversified, low-cost, long-horizon investment has meaningful variance, but a well-documented positive expected value over multi-decade periods, and a flaw that isn't 0. People who handle extra income well aren't more optimistic than everyone else, they're more attentive to the shape of outcomes. They'll take a narrow distribution with a modest positive expectation over a wide one with a thrilling upper tail, because they know they only get to run the experiment a handful of times in a working life, and small sample sizes are where wide distributions eat you alive. That doesn't mean never taking asymmetric bets, it means sizing them so a bad draw doesn't damage the structure underneath, which is exactly why the buffer and the debt clearance come first. Now for the finding that tends to surprise people. For a lot of workers, particularly earlier in a career, the largest available return on a lump of extra money isn't an investment product at all. It's the thing that raises the repeatable income itself. ONS figures have consistently shown that people who change employer see stronger pay growth than people who stay put, and the gap has at times been substantial. But changing jobs requires things that cost money. A gap between contracts, travel, a qualification, equipment, professional membership, or simply the financial breathing room to reject the first mediocre offer and wait for the third one. That last point is underrated. A cash buffer is not just insurance against disaster, it's negotiating leverage. Someone with 3 months of expenses in an account can walk away from a bad offer, push back on a low-ball number, or leave a role that's damaging them. Someone with nothing has to accept whatever's in front of them. The buffer is quietly buying you the ability to say no, and the ability to say no is worth a measurable amount of money over a career. The same logic applies to buying back time. Spending extra income on things that free up hours, provided those hours actually get redirected into something with a return, whether that's studying, building, resting properly, or simply not being exhausted, can outperform the same money sitting in an index fund, because a rested person who's 5% better at their job compounds that advantage across every future salary negotiation. The general principle, extra income spent on capability and optionality raises the ceiling on all your future income. Extra income spent on assets grows a pot. Both matter, but early on, the ceiling usually matters more than the pot. There's a failure mode on the other side of all this, and it deserves saying plainly. People who treat every pound of extra income as sacred and never allow their standard of living to improve tend to abandon the whole project within about 18 months, because permanent austerity while your income rises is psychologically unsustainable and frankly a bit pointless. The research on hedonic adaptation, going back to Brickman and colleagues in the 1970s, is often quoted as proof that spending doesn't make you happier. What it actually shows is more specific. Adaptation rates vary enormously by category. We adapt very quickly to recurring material upgrades. A better car becomes just the car in a matter of months. We adapt far more slowly to experiences, to time saved, to reduced friction, and to the removal of a persistent irritation. So the version of this that people sustain looks like a split. A fixed proportion of any repeatable increase, call it half, is allowed to raise the standard of living, deliberately and immediately. The rest is allocated before it arrives. The lifestyle improvement is real, visible, and enjoyable, which is what stops the whole system from feeling like deprivation. And because it's capped at a proportion, the gap between income and spending widens every single time income rises, which is the entire mechanism by which anyone accumulates anything. The one metric worth tracking here isn't your balance, it's the percentage of your income you don't spend. Balances go up simply because time passes. A savings rate tells you whether the system is working, and it's the number that changes when you get a raise and quietly absorb it all. So, the question worth sitting with: the last time extra money landed in your account, which of the 3 categories was it, and did you treat it accordingly? Drop your answer in the comments. Genuinely curious how the split looks across this audience, because the classification step is the one almost nobody does, and it's the one that quietly determines everything downstream. Thanks for watching.